Welcome to another tutorial video. As you can see, we're going to be going through a full crash course on oil and gas financial modeling and valuation here, covering the main three verticals: upstream, midstream, and downstream. I am going to link to a number of files and resources that we've shared before, but I also have some new ones here, including a simplified version of a NAV model, a net asset value model for an upstream company. So we'll go through all that and more as we proceed through this. Now, I'll warn you in advance that I'm not exactly concise, especially not with these crash course videos. And since we are going to cover many different topics here, it is going to take a while, but if you watch everything, you will be quite well prepared for oil and gas interviews. Since this video will be longer, I'm going to start with a short summary of all the verticals within oil and gas. And then if you want to watch or learn more past those first few minutes, you can certainly keep watching. Each vertical here has its own mini tutorial, and I will provide the timestamps below this video and also in the table of contents when we get to it in these slides. So for all the Excel files and resources here, you'll want to go to mergersandacquisitions.com/oil-gas-modeling-101. I'll link to this and pin it below the video as well. This is a summary from our newly released oil and gas financial modeling course from a few months ago that covers all these verticals in depth. So I would summarize this as follows. Upstream, also known as exploration and production, or E&P, consists of very CapEx, capital expenditure intensive companies, because they need to spend a lot of money to drill new wells in the ground to actually find the oil and gas, produce it, and transport it eventually. They are highly sensitive to commodity prices because their expenses are relatively fixed, but the revenue can fluctuate up and down tremendously based on oil prices, gas prices, and natural gas liquid prices. There is also a lot of specialized lingo, metrics, and methodologies here. The net asset value model that I showed you briefly before is one example of a specialized methodology, but there are a couple others to be aware of. Now, the midstream segment, also known as storage and transportation, or S&T, this consists of companies that transport oil and gas via pipelines or via maritime vessels, and sometimes also companies that simply store oil, gas, and natural gas liquids, and even water. These companies are more like utilities firms with high margins, predictable revenue, and predictable cash flows. And they're not that sensitive to commodity prices because most of the revenue comes from long-term contracts where the transportation and storage fees have been locked in and set at certain rates. The expenses are also relatively predictable. Now, they're not completely immune to commodity prices because if prices are higher, there will be more drilling and more production, so there will be more demand for usage of their pipelines and storage facilities, but they are the least sensitive to commodity prices out of everything in oil and gas. Then there is the downstream vertical, also known as refining and marketing, or R&M. Now, these are the companies that actually process the transported oil and gas and turn it into things like diesel fuel and jet fuel and gas for cars. They may also operate things like fueling stations for cars and trucks, for example. Now, these companies are sort of like low-margin industrials firms with less predictable revenue and cash flows, and they are moderately sensitive to commodity prices. Now, ultimately, they earn money based on the margin between what they pay for oil and gas and then how much they can sell it for. But as oil and gas prices change, that margin also tends to change. So they're not completely subject to price swings, but they are moderately sensitive compared to companies in these other verticals. I have here a table summarizing everything I just mentioned, and it goes through how you think about the revenue and expenses for these different types of companies, how you think about the CapEx, whether or not production and reserves are important, how sensitive they are to commodity prices, and also the common valuation metrics and multiples, and a few legal and tax and accounting issues to be aware of as well. So you can look at this. I will include it in the written version of this guide as well. I realize it's a lot of text to read, so I'm not going to go through all of this now, but think of it as more of a summary of everything here. So that's the high-level summary. We'll start with the upstream crash course, then we'll go into the midstream segment, then we'll talk about downstream companies, and then as a bonus, I will also briefly discuss oilfield services companies, integrated majors, and royalty companies. These are not featured currently in our oil and gas course, but I will say a few words about them and summarize the key points for you. So let's move to upstream, or E&P companies first. So E&P companies have reserves of oil and gas in the ground, and they produce a certain amount from these reserves each year. Now, as companies produce, they also try to replace their reserves via exploration activities and also acquisitions, because if they don't, eventually their reserves fall to zero and they will not be able to earn cash flow anymore, which is a big problem. The complexity comes from the fact that there are different types of reserves. Also, natural gas is measured in different units than oil and natural gas liquids, and you have to be able to convert between them to understand these companies. So the reserves are broken out like this. You have proved, probable, and possible, and the numbers at the top refer to the probability of successful recovery and extraction. Proved is separated into proved developed and proved undeveloped. Proved undeveloped just means that they know the resources are there in the ground, but they haven't actually drilled the wells to be able to extract and produce from that area yet. And then proved developed is further split into proved developed producing and then proved developed non-producing, which are exactly what the names sound like. Most financial models tend to focus on proved developed and proved undeveloped reserves, but you will sometimes see probable and possible reserves in more speculative and advanced models as well. You can group these together and say that the 1P category is the proved reserves, 2P is proved plus probable, and then 3P is proved plus probable plus possible. There is some question here about the exact probabilities and whether the greater than or equal to 50% refers to just probable or also proved plus probable, and the same thing for possible. So there are some nuances around the exact probabilities here, and so you'll see different weightings assigned to these types of reserves in different models, but this is the basic idea. Now with the units, oil and natural gas liquids are typically measured in barrels of oil, where 1 barrel is 42 gallons. Natural gas is measured in 1,000 cubic feet or MCF, M standing for 1,000 here. Now you convert between them based on the energy produced, which is measured in millions of British thermal units. 1 barrel of oil gives you about 5.8 million British thermal units, and then 1,000 cubic feet of natural gas gives you about 1 million British thermal units. And so based on that, we normally say that 1 barrel of oil equals 6,000 cubic feet equivalent of gas. We can also then say that 1,000 barrels of oil equals 6 million cubic feet equivalent of gas, and 1 million barrels of oil equals 6 billion cubic feet equivalent of gas, and 1 billion barrels equals 6 trillion cubic feet equivalent of gas. When you're forecasting an upstream company, everything should flow from the net asset value model, which is essentially an asset level forecast of the company's long-term cash flows with no terminal value. There is no terminal value because you simply assume that the wells decline and eventually they stop producing at economically feasible levels. So the first step is to split the company into existing production, their proved developed reserves, and then their undeveloped reserves or proved undeveloped. And you might go into probable and possible in more advanced models, but this is the basic setup. You then assume that the proved developed production declines over time until it's no longer economically feasible. So I'm going to pull up the simplified NAV model here and show you what this looks like. We have some assumptions at the top for the commodity prices and something called the price deck. We also have some expense assumptions, and we have the output of the NAV model up here in the low, mid, and high prices for the commodities. But I want to go down and show you how we have set this up and split it into proved developed reserves and then proved undeveloped reserves and have separate assumptions for each of these. For the proved developed reserves, we do exactly what I just described, where we have the beginning reserves, we have a certain amount of daily and annual production here, and as we keep producing, the reserves go lower and lower until they eventually reach zero. Now, of course, it doesn't mean that there's literally nothing left in the ground. It just means that at this point, what is left there is no longer economically feasible to produce from. So this is the basic setup for a NAV model. Now, the next thing to do is to assume that new wells are drilled in the undeveloped areas, and then to forecast the initial production and declines over time from an average well in each region. Now, we covered some of this in a previous tutorial on this channel on the type curve in oil and gas, so take a look at that if you want a refresher of how this works. In this specific model, to bring it up and show you an example, here, if you go down, you can look at the PUD wells, the proved undeveloped wells, and you can see that this is what we're doing. We're taking an average well right here. We're saying that it starts producing at a certain level. This is in million cubic feet equivalent. And then it declines by 36%, 16%, 13%, 10%, 9%, 8%. And it keeps going down like that until we produce everything from the well after about 28 years. Then we have to go and aggregate all this production, which involves a fairly tricky offset formula. But essentially, we look at the production from all these wells that are drilled. We drill 55 wells per year, and we sum up all the production from those in million cubic feet equivalent of natural gas, and we get to our numbers from the proved undeveloped production like that. Then we have to forecast the oil, gas, and natural gas liquid prices in different scenarios to project the revenue from the proved developed and proved undeveloped production, and maybe others depending on the model. So if you go up and look at this one, for example, we have the production from the proved developed reserves, we have the price deck, so the pricing assumptions for the commodities, and we get to the revenue like that. So for the gas revenue, for example, we take the gas price, we multiply by the volume of gas produced. And for the proved undeveloped production, it's similar, except here we're aggregating production across many different wells, and so it starts off lower and then rises to a high level, reaches a peak, and then starts declining again. But the revenue forecast is the same. It's still based on the price times the volume produced. Then we forecast the main operating expenses and CapEx line items to get the cash flow. So for most of these, there will be lease operating expenses, production taxes, transportation costs, and so we forecast all of those to get the total asset level expenses. We subtract the drilling CapEx for the proved undeveloped regions and get to the cash flows like that. And then we can also discount the cash flows from these proved undeveloped reserves and then above from the proved developed reserves to get the discounted cash flow in each year from that production type. The next step is to aggregate all the cash flows, discount them to present value, and then add or subtract the usual enterprise value bridge items. So if you go to the simplified NAV model and go to the DCF tab right here, you can see where we do this, where essentially we are using some transpose functions here to sum up all the production from all different sources over each year. We're getting the revenue like that, we're getting the expenses, we get down to EBITDA, we calculate the cash taxes based on some deductions for depreciation, depletion, and amortization, and then we get to the after-tax unlevered free cash flow. Now once we have all that, we can go back to the main NAV model tab and we can link in the value of the cash flow from both reserve types right here. We can also link in the values of some of these other items like the G&A and employee compensation. We subtract the cash taxes. That gets us to the after-tax asset value. We factor in non-core assets, and then we add cash and cash-like items, subtract debt and debt-like items to get to the net asset value. We divide it by the share count and get to net asset value per share. And we can see that in this case, the company looks slightly overvalued, though not tremendously so. Maybe they're overvalued by about 10% based on this if you look at the mid-range numbers and then also the low and high numbers. And of course, we can create some sensitivity tables based on this to see how different assumptions change the output here. So that is the NAV model, and it really is the primary valuation methodology for E&P companies and replaces the standard DCF. The main differences are no terminal value. You use an industry standard 10% discount rate if you're in a developed market, so you don't calculate WACC the normal way. Cash flows reach zero at the end, and there is a split between the asset level and the corporate level here. Now, if you're building a three-statement model on top of this, it should really flow directly from the NAV model. You will need to make some additional assumptions for the working capital, debt, and dividends. You may have some hedging and tax schedules in more advanced models, but really most of it should flow from the revenue and expense and CapEx forecasts in your NAV model. Now, in terms of other valuation, you can certainly look at comparable companies and precedent transactions here, and you'll still screen based on industry, geography, and then for the financial criteria, typically you use reserves or production rather than EBITDA or revenue or something like that. You also use different multiples, enterprise value to proved reserves and enterprise value divided by daily production, for example. You could also look at something like equity value divided by cash flow from operations or even free cash flow, but we generally don't do that. Another industry-specific multiple here is enterprise value to EBITDAX, where EBITDAX equals EBITDA plus the exploration expense. This normalizes for some accounting differences because some companies treat unsuccessful exploration differently, some expense it and some capitalize it, and so this just normalizes for that. So I have a set of public comps here for this company, Range Resources in the US. You can see the EBITDAX metric. We're listing proved reserves and daily production for each one of them. We're listing their production regions. And then the oil mix, the proved developed to proved mix, something called the RP ratio or reserve life ratio. And then for the multiples down here, we have enterprise value to EBITDAX, and then we have proved reserves and daily production multiples as well. These are both based on enterprise value. And so based on this, we can see that according to some of these, this company looks quite expensive right now, but then on some of these others, it actually looks cheap or somewhat undervalued, so we get a bit of a mixed message from these public comps. That's about it for Upstream. Let's now move to Midstream. So midstream companies, as I mentioned before, are really like utilities firms because they earn fees for each unit of oil, gas, natural gas liquids, or water transported or stored, and they have pretty predictable revenue and cash flows because they're typically governed by long-term contracts that lock in the volume and the fees to some extent. Production reserves are not relevant unless the firm happens to operate in the E&P sector as well. Commodity prices do make some difference here, but overall midstream companies are the least sensitive because they simply charge fixed fees based on the volume of energy transported or stored. Now there is an indirect effect because yes, when prices are higher, there will be more demand. When prices are lower, there will be less demand, but it's much less of an effect than you see in any other vertical here. So I have this diagram that shows the business model for a midstream company. You start with capacity for their pipelines or storage, then there's a utilization rate, and then you have fees per unit, and you multiply all those together to get to total revenue. You subtract COGS and OPEX, you subtract the net interest expense, income taxes, which may be very significant or may be very minimal depending on the corporate structure. We'll get to that. That gives you net income. Then you have the typical items that get you from net income down to free cash flow. So the change in working capital, the D&A add back, other non-cash adjustments. You subtract all forms of CapEx. That growth and maintenance CapEx feeds back into the capacity. Some of it is for maintaining the capacity, and then others, the growth CapEx is for growing that capacity. Then you factor in the dividends or distributions to the equity investments, the non-controlling interests, the preferred stockholders if they exist, and that gets you something called distributable cash flow. Now with that distributable cash flow, companies can take it and use it to repay debt or to repurchase stock or to issue dividends or make distributions. And of course, if they issue or repay debt, that will affect their net interest expense. The net income, meanwhile, and then the stock repurchases will feed into the equity value and affect that. And when you take the dividends or distributions and you divide them by the equity value, you get the dividend or distribution yield, which is a very important metric for these firms. With midstream companies, the master limited partnership or MLP structure is important and very common in the US. It doesn't exist outside the US. Over time, it has become somewhat less common because of lower corporate tax rates following the 2017 tax reform in the US. The idea is that an MLP is a pass-through entity that pays no corporate taxes or very low corporate taxes. The unit holders, the shareholders, receive distributions, dividends, and they're taxed at their personal income tax rates. The complexity comes from the fact that MLPs have general partners that do day-to-day operations and typically own about 2%, and then limited partners, unit holders or shareholders that are passive investors, but the distributions vary and they will not necessarily be awarded in a 2%, 98% ratio. So distributable cash flow, as we mentioned, is one of the most important metrics, and it can be defined different ways, but we typically say it's EBITDA minus cash interest expense, minus cash taxes, minus preferred dividends, minus maintenance CapEx, and then plus or minus distributions from or to other entities. The distribution yield is the distributions divided by the equity value or the distributions per share divided by the current share price. And then the distribution coverage ratio is the distributable cash flow divided by the distributions. Other than that, you can still use EBITDA and enterprise value to EBITDA, the leverage ratio, the interest coverage ratio, the returns-based metrics. All those are still valid for midstream companies. Now, in terms of the financial statements and cash flow forecasts, they're pretty straightforward, but the ownership may sometimes create some complexity. The first step here is to forecast capacity, utilization, and revenue and focus on very modest growth expectations. If you look at our dividend discount model example for DT Midstream here, you can see an example of this where we are pretty much just forecasting the overall capacity. We are assuming some growth from growth CapEx spending here, but otherwise the capacity doesn't really change by a huge amount each year. So we do that. We also forecast the fees per unit, and we use that to get to the total consolidated sales. Then we forecast the CapEx, which is mostly maintenance and OPEX. Most of the OPEX is linked to capacity or revenue, though there are some variations. Let's just bring up this model again. So here you can see that most of our CapEx here is from maintenance, and we're basing it on a maintenance CapEx per total capacity number. There is some capacity growth from CapEx and from the growth CapEx spending, but it's pretty small next to everything else. And most of the other numbers here, like operating expenses, maintenance expenses, D&A, are all based on the company's total capacity. Now, if you have a full three-statement model, you will project the statements at this point. We don't have it for DT Midstream, but I'll bring up another example for Western Midstream Partners, which is covered in our full oil and gas course. And with this, we go through a lot of the same setup, but we have the full three statements. So we do forecast the income statement, including a lot of different line items on them, the working capital line items. And one difference here is that we look at a metric like the cash before debt reduction and unit repurchases, And we use that to determine how much debt the company repays and how many units it repurchases each year. And this is something you have to pay special attention to for midstream companies because they tend to have excess cash flow. And so you really need to think about how they're spending it, whether it's on debt reduction or stock repurchases or acquisitions, for example. Then for step 4, you calculate the key metrics like distributable cash flow, the distribution yield, return on equity, and so on. I'll go down and show you the bottom of our model here for Western Midstream Partners, where we calculate the distribution coverage ratio, the distribution yield, the distributable cash flow yield. All these are from the perspective of the limited partners because this is an MLP company, not a standard C corporation, so we have to separate out the investor groups here. If this were a C corp instead, the distributable cash flow would be lower because cash taxes would be much higher. The yields would also be lower as a result of this. You can also look at public comps and precedent transactions here, and you still screen by industry, geography, and financials, such as EBITDA. Try to avoid mixing MLPs and C corporations if you can. It's not the end of the world if you have to, but it's a little bit better to keep them separate if possible. For the key metrics, you still look at the EBITDA multiple, the price to distributable cash flow, or the equity value to distributable cash flow multiple, and the distribution yield as well. So bring up an example here from Western Midstream Partners on the Pub Comps tab. We have screened these companies by region and company type and EBITDA between 500 million and 5 billion. And we display EBITDA, distributable cash flow, and distributions as some of the key metrics. We also look at the yields and growth rates on these. And then for the actual valuation multiples, we focus here on the EBITDA multiples and then the equity value to distributable cash flow multiples. So there are certainly others you could look at. We choose to make those the core focus here. You can also build a standard DCF based on unlevered free cash flow, so that still works, but just be careful because you have a bunch of different cash flow metrics here. Unlevered free cash flow, levered free cash flow, distributable cash flow, and they're all different in sometimes very subtle ways, so you have to be very careful about keeping them straight. And of course, you can look at a dividend discount model or discounted distribution analysis for MLPs. For this one, for a good example, take a look at our dividend discount model for DT Midstream, and you can get a sense of how this works. Really, the key point here is that if you're building a dividend discount model, it should really extend from your 3-statement model, and you should make sure that the distributable cash flow and the distributions are based on reasonable numbers and percentages. You want to use cost of equity and also an equity value-based terminal multiple. So here, for example, for DT Midstream, you can see what we're doing, where since this is a dividend discount model, we use the PE multiple for the terminal multiple in this analysis rather than the standard EBITDA multiple. Let's move on to downstream now. So downstream companies earn money based on the margin between what they pay for raw oil and gas and then how much they sell the processed version. So diesel fuel, jet fuel for planes, gasoline for cars. They earn money based on what they sell that for versus what they paid for the raw materials. Production and reserves are not relevant unless they also have upstream operations. Commodity prices matter, but less so than for upstream companies, but more so than for midstream companies. The margin matters the most, but the thing is that oil and gas prices do affect that margin as well, so that's how they factor in. Once again, I have a diagram of the business model. You have the refining capacity, the utilization rate, and then the price per ton of fuel produced. That gets you to total revenue when you multiply them. You subtract COGS and operating expenses. Here, you have a couple different metrics such as the crack spread, which is the average price per barrel of oil sold minus the average cost per barrel of oil, and that in large part determines COGS. The refining margin is a more complete version that reflects the all-in cost of oil and more directly influences these numbers. So both factor in, but the refining margin is the more complete version here. Then you have the net interest expense, income taxes. You deduct those to get to net income, and then you have the standard cash flow items like the change in working capital, D&A and non-cash adjustments, all forms of CapEx. They feed back into the refining capacity. And then you have debt repayments, minimum cash requirements, and that gets you to the cash flow surplus or deficit. So depending on whether it's a surplus or deficit, the company might issue debt or repay debt. It might issue stock or repurchase stock, and it might issue dividends or not issue any dividends. And of course, issuing or repaying debt affects the interest expense. If you look at a downstream company's financial statements, there are quite a few new different metrics and KPIs like crack spreads, refining margins, throughput yields. You will see more varied capital structures depending on the macro environment and how the company is performing. So the company is not always going to issue debt. It's not always going to repay debt. It's going to depend on what the refining margins at the time look like. Many downstream companies also operate in other segments, such as retail stores, renewables, power generation, for example, and so you have to forecast those as well. In the forecast, you start with the capacity, utilization, and refining margins. So I'll bring up an example here for the downstream company in our course, or the downstream case study in our course for Saras SPA, an Italian refining company. And if you look at what we're doing, we start with, of course, a top-level forecast for the overall oil prices. We have a euro to US dollar exchange rate forecast, and then we have our refining capacity. We have the refinery runs, which are based on the utilization rate and this daily or annual refining capacity. We get to the tons of fuel produced from that based on a tons of fuel per barrel assumption here. And ultimately, we get to the fuel revenue based on the amount of fuel produced times the average price per ton of fuel sold. We also have a refining margin, and that in turn tells us something about the cost per barrel of fuel sold and the price per barrel of fuel sold. Now the CapEx part is shown down here. We have maintenance CapEx, which comprises the bulk of it, but we also have a little bit of growth CapEx as they expand the refinery slightly over time. In terms of other business segments here, this particular company also does electricity production, so we forecast that capacity for their natural gas plant and for their renewables, and we get to the potential electricity production like that. We also have a capacity or utilization factor on these, and then a revenue per production or a tariff rate on the electricity. And putting all these together, if we just go down, we get to revenue from the sale of electricity here, which is based on simply the electricity production and then the tariff rate applied to that production. And then finally, for the full financial statements, it's not really too complicated. The balance sheet forecasts are based on pretty standard setups, such as accounts receivable being a percent of revenue, for example. Many of the income statement line items are simple percentage growth rates or are linked to the refining capacity. One thing I will point out is that, as I was saying before, you see a lot of fluctuations here where sometimes the company repays debt. In other periods, it has to issue more debt if it has a cash flow deficit. Sometimes it issues significant dividends. Sometimes it has to cut the dividends because the refining margins fall and the cash flow is just too low. Maybe it moves into a deficit position, and so it simply can't issue dividends. In terms of the valuation for downstream, you can still use public comps and precedent transactions. You can screen based on financial criteria like EBITDA, geography, and industry. The key multiples tend to be enterprise value to EBITDA and also the PE multiple. I'll bring up an example here for our valuation in this model. And essentially, we're looking at European refining and marketing companies with EBITDA between 100 million euros and 2 billion euros. Revenue, EBITDA, and net income are the key metrics. We look at the growth rates on them and the margins. And then we look at revenue multiples, EBITDA multiples, and PE multiples. But really, we mostly care about the EBITDA and PE multiples in this sector. You can still use a discounted cash flow analysis. The terminal value assumptions can be a little bit tricky due to cyclicality, but you can certainly use a standard DCF as well. You just have to make sure that you properly reflect the different scenarios in your analysis. So here, for example, we have to be really careful with what we use for the EBITDA multiple because the subject company here is trading at a very different multiple than the public comps. And so we sort of have to triangulate a little bit and pick something in the middle that takes into account the fact that this industry is very cyclical, and so the EBITDA multiples could vary a lot over time. The NAV model and dividend discount model are not relevant here. You could use some of the parts for the valuation if the firm has significant operations in other segments such as upstream and midstream, or if it also does some oil field services, or if it operates a lot of retail stores, for example. So that's it for downstream. Let's move on to a few other oil and gas company types. You can think of this as a bonus if you've already made it this far and you want to learn even more. So oilfield services is another vertical here, and the main verticals within this are drilling and then equipment and services. Really, oilfield services is similar to a standard business or professional services firm, but with added commodity price exposure. So for the drivers and KPIs, if you're looking at something like an offshore drilling company, the operating days, the utilization rates, and the daily rates that they charge for their ships to do this are all very important, and this varies based on the rig type. So I'll bring up an example here for a Chinese company that does this. And they have this broken out based on the operating days per vessel right here. And you can see how Depending on what commodity prices are like and what the macro environment is like, they will be operating their rigs and barges here more or less. And if you scroll up a little bit, you can see their quotes for their daily rates for their jackup drilling rigs and their semi-submersible drilling rigs. And you can see some other data on the operating days and the utilization rates in different segments. So you'd use these types of drivers to forecast these companies. For the expenses, they're typically based on the number of vessels or teams operating, the fuel expense, the employees required, the average salary per employee, subcontractor payments, things like that. For valuation, you can use EBITDA multiples, you can use PE multiples, and in some cases you can use price to NAV multiples. Confusingly, this is a different type of NAV. I'll pull up an example here for Transocean. With this type of NAV model, essentially you look at all of the company's rigs or maritime vessels or ships, whatever you want to call them, and then you'd assign some type of market value to them. You'd value the entire asset side of the company's balance sheet and then subtract the liabilities from that to get to the net asset value based on the market value of all their vessels minus all their liabilities and owed amounts. So it's a different type of NAV model, but it's similar in that you're still valuing the assets and subtracting the liabilities. It's just that you're doing it in a different way and you're not building a long-term cash flow forecast going out 50 years like you would for an upstream company. Another vertical within oil and gas is the integrated major category. And here you have large diversified companies that do everything. ExxonMobil, Shell, BP, for example, and also many state-owned entities like Saudi Aramco, a lot of Chinese companies, Rosneft in Russia. Now, Saudi Aramco, for example, is publicly traded, and so is Rosneft, but the government owns huge percentages of these companies, so I count them as state-owned, even though they're technically public companies now. So with these, you often use the sum of the parts model because they operate across so many different segments. But if you actually look at their earnings and their cash flows, upstream tends to dominate. I have a graph here showing that for many of these companies, upstream accounts for somewhere between 50 and 90% of their adjusted earnings. So when upstream is that dominant, you still tend to focus on it in the analysis, even if they do other things technically. And then one final oil and gas company type is the royalty company. Effectively, they're a subset of upstream or E&P because they also earn based on oil and gas production. The difference is they don't do any drilling or production themselves. They simply own productive land, and when other companies produce from it, they get a percent of revenue from it. They have very simple statements. They have no corporate level taxes because a trust is a pass-through entity. And to forecast them, you need to analyze the drilling or production overall in the region to get a sense of what revenue might look like. So I have an example here for the Permian Basin Royalty Trust. You can see how simple the statements are. The balance sheet has literally 5 or 6 items on it total, and the statement of distributable income, this is probably the simplest income statement you've ever seen for a public company. So it's very, very simple, and really it all depends on the underlying drilling activity and the prices you expect. For valuation, you could use revenue multiples, EBIT multiples, possibly also a NAV model, but it's not really a NAV model. What it really is just a long-term cash flow forecast or revenue forecast with very minimal expenses. And often the time period might be limited to the terms of the royalty agreement, however long it lasts for. So you value companies like that. You tend to see wild swings in valuations here because they don't really have much going on. They're really bets on commodity prices one way or the other. So that's about it for this crash course. Let's do a quick recap and summary now. Upstream companies are by far the most different. They're very capex intensive. You have to split up everything into the proved developed reserves and the proved undeveloped reserves. Forecast declining production from the proved developed ones. For the proved undeveloped ones, assume new drilling, aggregate all the cash flows from all the wells that are drilled each year, and sum up everything to get the revenue, expenses, and cash flows. Take the present value of all that, factor in the non-core items, and then go across the bridge to get the net asset value, and everything else flows from this NAV model. You can also use multiples like enterprise value to prove reserves and enterprise value to daily production, in addition to enterprise value to EBITDAX to value these types of companies. Midstream companies are more like utilities firms, and so you forecast them based on capacity, utilization, and the fees that they charge per unit of energy transported or stored. Many of the expenses also trend with capacity. Margins tend to be very high, so distributions and distributable cash flow here are very, very important. You can value them with EBITDA multiples with a standard DCF, but you could also use a dividend discount model or a discounted distribution analysis. And then you have other multiples such as the equity value to distributable cash flow. You could even use distribution yields to value them. For downstream, So these companies process the oil and gas and turn it into fuel, gas, jet fuel, for example. You also forecast them based on their capacity, the utilization rate, and then the prices that they can sell their fuel for. The crack spread or refining margin in large part determine what their expenses look like. You can value them with a standard DCF. You will almost always build in scenarios because they are somewhat sensitive to commodity prices. And in terms of multiples and public comps and precedent transactions, you can use EBITDA, you can use the PE multiple, you can even use the revenue multiple potentially, but you tend to focus more on the profitability-based ones for screening purposes and also for valuation purposes. And then we talked about oilfield services, which are quite similar in a lot of ways to the downstream segment in that they're somewhat lower margin and they're moderately sensitive to oil and gas prices. You can use EBITDA multiples, you can use PE multiples, and you can forecast them based on metrics like the operating days, the daily rate, the utilization rate of their rigs for offshore drilling companies, for example. Integrated majors like ExxonMobil, some of the parts is most applicable, but keep in mind that they tend to be dominated by the upstream segment, so focus on that one. And then finally, you have royalty companies that aren't exactly like real companies at all. They just earn a percent of revenue from other companies that are actually drilling and producing on their land. So you can certainly use standard multiples. You can create some type of long-term cash flow or revenue forecast based on however long the royalty agreement lasts for, but they're really a simplified subset of the upstream vertical. That's about it. Hopefully now you know a lot more about this sector and you have a couple of good examples to work from in terms of Excel models and other resources from our course.